Hello everyone. Today I am going to talk about income from house property. In this lecture, we will study about basis of chargeability, the procedure of determination of tax liability under house property, various types of house properties, and some important concepts that are to be considered while determining tax liability under the head of income from house property. Okay, dear students, when we talk about income from house property, it is necessary for all of us to understand the basis of charge, or it is called as basis of chargeability. So according to section 22 of Income Tax Act 1961, the basis of charge is the annual value of the property. Means when we are going to calculate taxable income under house property, we must consider the annual value of that property. Okay, so the tax liability is depends upon the annual value of that particular house property. So income is taxable under the head of house property if three conditions are satisfied. So now we are going to learn about three basic conditions which determine the basis of chargeability. So the first condition is that the property should consist of any building or land apportionment thereto. Okay. Rental income of vacant plot which is not apportioned to the building is not chargeable to tax under the head of income from house property because it is taxable under the head of income from house property or profits and gains from business or profession. But whatever building or property or land apportionment thereto is always chargeable to tax under the head of income from house property. Okay. Second condition is that the assessee should be the owner of the property. Means annual value of the property is assessed to tax in the hands of owner even if he is not in receipts of any income. So whoever is the owner of the property, he is liable to pay tax in the case of income from house property. Okay. Third basic condition is that the property should not be used by the owner for the purpose of any business or profession carried on by him, the profit of which is chargeable to income tax. So these are the three basic conditions which determine the basis of chargeability or taxability of house property in the case of income from house property as per section 22 of Income Tax Act 1961. So dear students, now it is must for all of us to understand various types of house property. Even while determining the tax liability under house property, we have to classify the house property into various categories depending upon their nature. Okay. So first type of house property is self-occupied house property. It means the property or the house which is used by the assessee for his own residential purpose. In short, the house property which is used by the assessee or person for his own residential purpose, that property is to be treated as self-occupied house property, and gross annual value of self-occupied house property is always nil or zero. Means no tax is payable in the case of self-occupied house property. Okay. Second type of house property is let out house property. It means the property or house which is given on rental basis to other persons for their residential purpose. So in that case, the person who taken a house for their residential purpose called as tenant, and tenant is liable to pay certain amount of money as a rent or monthly rent to the owner of the asset. In that case, that property which is treated as a let out house property is also chargeable to tax, and there is a separate procedure to determine taxable income in the case of let out house property. Okay. Then third type of house property is called deemed to be let out house property. It means it is the property or house which is not actually let out. It is considered as a deemed let out house property. For example, the person having three houses like house A, house B, and house C, and he is using all three houses for his residential purpose. So in that case, only two houses are to be treated as self-occupied house property as per the income tax rule, and remaining one house is to be treated as deemed to be let out, even it is not actually let out, and such house property is chargeable to tax under the head of deemed to be let out house property. And taxable income or tax liability is determined just like as income from let out house property. Okay. Fourth type of house property is house used for own business or profession. Means the house which is actually used by the assessee for his own business or for his own profession. So these are the four types of house properties that are to be considered while determining taxability under the head of income from house property. Okay. So dear students, now we are going to understand the annual value. As already I told that in the case of house property, taxability is depends upon annual value. Means we have to find out gross annual value as well as net annual value of the concerned property while determining tax liability. Okay. So it is must for all of us to understand the concept of annual value, and it is normally said that annual value of the house property is always chargeable to tax, and the annual value is based on various basic concepts under house property. Means calculation or determination of annual value is based on various types of concepts which are related to house property. So now we are going to learn few basic concepts which are must for determination of annual value. The first is fair rent. So fair rent is the rent which is similar of the rent of other property in that particular locality or area. Okay. Then second concept, that is called municipal valuation. So municipal valuation is the value as determined by the municipal authorities for levying municipal taxes on house properties. The local authorities like Gram Panchayat, municipal corporation and other local authorities of government which determine the municipal valuation of house property for charging municipal taxes. So whatever municipal valuation which is assigned by the local authorities are also considered while determining annual value of the property. Okay. Third concept, that is standard rent. So standard rent is the rent which is fixed under the Rent Control Act. If the standard rent has been fixed for any property under the Rent Control Act, the owner cannot expected to get a rent higher than the standard rent. Means it is the rent which is designed or it is confirmed or fixed by the government as per the Standard Rent Control Act. That is also considered while determining annual value of the property. Okay. Next concept, that is unrealized rent. It means the rent which the owner cannot realize. So unrealized rent means the rent which cannot be recovered or received from the tenant of that property. So unrealized rent also considered while determining annual value of the property. Next concept, that is called as vacancy period. Vacancy period means the period in which house property is vacated or vacant. Next basic concept, that is called as annual rent. It is the rent of previous year or the part of that previous year when the property was available for letting it out. So annual rent means the rent or total rent of 12 months which the assessee is going to collect from the tenant. Okay. So these are the few basic concepts that are to be considered while determining annual value of the house property. Okay. Then we are going to learn about determination or computation of gross annual value and tax liability under house property. As earlier I told that the procedure of tax determination under each type of house property is different. So first of all, we have to learn the procedure of tax determination in the case of self-occupied house property. So first of all, we have to consider gross annual value. And as you know that gross annual value is always nil. So normally the municipal taxes paid is deducted from gross annual value. But in the case of self-occupied house property, if gross annual value is nil, then municipal taxes paid also considered as a nil. So ultimately, in the case of self-occupied house property, net annual value of the property is also nil. And as per the section 24, the assessee is allowable as a deductions. So the standard deduction is allowable as a 30% of net annual value, but it is not applicable in the case of self-occupied house property because net annual value is nil. Second deduction which is allowable to the assessee under house property, that is interest on loan, or it is also called as interest on borrowed capital. So the maximum exemption limit of interest on loan taken for construction or for purchase of house property is rupees 2 lakhs. Means assessee can get the exemption of interest on loan in the case of self-occupied house property up to rupees 2 lakhs only. So normally in the case of self-occupied house property, whatever interest on loan which is paid by the assessee is to be treated as a loss from self-occupied house property. Okay, so this is the simple procedure of computation of gross annual value and tax liability of self-occupied house property. Okay, then next we are going to learn about the procedure of computation of gross annual value and tax liability in the case of let out house property as well as deemed to be let out house property. So as you know that it is necessary to calculate gross annual value as well as net annual value of the property for the purpose of tax calculation. So the gross annual value is based on 3 steps. So we have to consider these 3 steps while determining gross annual value of the property. Okay. So the first step, which is related with reasonable letable value, and reasonable letable value means RLV is to be calculated as a list of the following, and we have to consider municipal value or fair rent, whichever is higher, but subject to standard rent. So whatever higher amount of municipal valuation and fair rent is to be considered and is compared with standard rent, and least amount from these two is taken as a reasonable letable value. Then we have to also consider step second for the purpose of determination of gross annual value, and step second is related with actual rent received. So whatever actual rent received during the year for the house property, that is to be considered, and the rule is if actual rent is more than reasonable letable value, then actual rent will taken as a gross annual value. In that case, if actual rent is more than reasonable letable value, we have to consider actual rent as a gross annual value. But if actual rent is less than reasonable letable value, then we have to consider step third. In that case, step second is not applicable. And in the case of step third, the rule is if actual rent is less than reasonable letable value due to loss due to vacancy period, then the gross annual value is rent for the period, that is annual rent minus loss due to vacancy. That is called as unrealized rent. So whatever amount determined by considering annual rent and unrealized rent, we have a actual amount that is to be considered under step third and is to be considered as a gross annual value. So dear students, these are the 3 steps that are to be considered for the purpose of determination of gross annual value. Okay. Once gross annual value has been determined, we have to deduct municipal taxes paid from the gross annual value for the purpose of calculation of net annual value. So the deduction of municipal taxes is allowable if it is paid only. So whatever municipal taxes payable are not allowable as a deductions while determining net annual value. Okay, so once net annual value, that is NAV, has been determined, then the assessee is allowable as a deductions under section 24. So the first deduction under section 24 is a standard deduction, and it is 30% of net annual value. Okay. The second deduction under section 24 is allowed to the assessee in the case of let out or deemed to be let out house property for interest on loan taken or interest on borrowed capital, and there is no statutory limit for interest on loan taken for let out house property. Means whatever amount of interest on loan which is paid by the assessee in the case of let out house property is allowable as a deduction. Okay. And if the assessee is having more than 2-3 houses, so whatever loss from self occupied house property is applicable there, that is to be adjusted against income from let out house property, and then finally we can get the taxable amount from house property. Okay, so this is the simple format of tax determination in the case of let out or deemed to be let out house property. Okay, thank you.